Hello, everyone. Welcome to Calling All Real Estate Investors. We are here every Tuesday at 1:30 p.m. Pacific time, 4:30 p.m. Eastern time for a live event with Caeli Ridge from Ridge Lending Group. During today's call, please utilize our chat feature. If you have any questions throughout the call, you can just pop those in there at any time, and then we will get to them once we are able to. And let's see. Just a reminder, we do love your participation, so please chime in throughout, as participation is very important during these calls. And today, Caeli will be going through the list of the top 10 things to do during a loan transaction, which is the reverse of last week's. If any of you caught that or were here last week, we went over what not to do during a loan transaction. So this will be really helpful information that Caeli will break down and elaborate more on. And at the end of this call, an email will be going out to everyone with that list, so you can have it handy for your next loan transaction, or if you didn't catch everything today, we'll also have that available on our website, ridgelendinggroup.com. All right, thank you all so much, and handing it on over to Caeli.
Yay, Carly. Thank you, my dear. Hi, everybody. Thanks for joining me today. Okay, like she said, we're going to go over the top 10 things that we want you to remember, that we want you to do. I'll get into those in just a second. I had a couple questions for you guys. I had Carly make a couple of polls for me, for us, just to kind of get an idea. If you're watching this post the live and as a pre-recorded or an already recorded after the fact, if you want to email to info@ridgelendinggroup.com and answer these questions for me, it might be helpful for me on an ongoing basis. The first one, Carly, if you could pull up the Bigger Pockets one. I want to know, everybody that's here with us today, who knows about Bigger Pockets? Who knows what Bigger Pockets is? And are you actively utilizing its content? So any of those, let's see, heard of it? Rarely. Yeah, any one of those is fine, guys. If you guys can just answer that for me. Just curious to know how many of you follow that and are aware of the tools that Bigger Pockets provides real estate investors. 3 of 7. Okay. For those of you that have never heard of it, I will just let you know, Bigger Pockets is a very useful resource and tool, all about real estate investing, every facet that you can imagine. The reason that I'm asking is I've been asked to participate in a panel, a lending panel, that we're going to be recording on this week. So I was just curious, of those of us that are here today, how many of you know about it and look at it and watch it? So thank you for that. Carly, will you put up the second poll? Here's the next one, you guys, for you before we get started on today's topic. I am curious because, you know, sometimes we have bigger participation, more attendees. Sometimes we have more collaboration during these things. But I'm curious, from your perspective, do you like the live kind of feel of it, or is it something that you would prefer to not have to be, you know, stricken with 1:30 Pacific, 4:30 wherever you are in the country or the world? Would you rather just kind of take it on your own time? So if you can tell us who really likes the live version of this versus, you know, I'll just do some pre-recorded stuff and you guys will have access to it at your discretion, when you want, how you want, etc. Okay, looks like we got some live. Okay. If you guys like it live, I love it. I don't mind doing it at all. I just want to make sure that it is valuable to you. And if this is what you want, then we'll keep doing it, even if it's just a few of us. I mean, it's good for me to stay on topic too with what might be going on in the industry that, you know, might be relevant in real time that I can share. Okay. Thank you, Miss Carly. That was great. Thank you, guys. Okay, if you can put on the screen, Carly, the top 10 things, I'm just going to roll through those. As always, please let me know if you have questions. Carly's going to be monitoring and she will bring them to my attention. And I think we're doing that poll thing, Carly, wrong, where I don't think they can see the results. I think we have to share them.
Oh, yes. Okay. Sorry about that. Do you guys see this now?
They do now because I said
Okay,
share. Anyway, we'll do that next time, but
yes,
that's what we got for
absolutely.
Keep It Live. Thanks, Carly. Okay, green means go. These are the things that we want you guys to remember and know. I think I said this last week. Some of this might be obvious, but I'll go into a little bit more detail. Other things maybe you didn't think of, so I think it's useful. Okay, so number one, do share your investment goals with your loan team. Obviously, I think most of you on with us today know that Ridge is not transactional. It's not like you're going to show up at B of A or Chase or something and say, hey, I need a loan for an investment property, where they're just going to say, okay, give me these documents and we'll close it. They don't really care what your investment goals are. And even if they did, they probably wouldn't know what to do with them. So a big part of what we do, I think, and a value add for you is really understanding what it is you guys are trying to accomplish, right? Today and next week and for the long term, so that we can help prepare you as things change, not only in your qualifications and what I'm always harping about, understanding how those change and how do you optimize DTI and things, but also as products and availability of new loans or the removal of existing loans or how that moving target can change. And it does change over the 25 years that I've been doing this. I can tell you that the lending platform that we're occupying now is very, very different than it was in 2010 or 2007. Very, very different. So it's important that we understand what it is you're trying to get out of this today and all the way into retirement and beyond, so that we can appropriately guide you and make sure that you've got real-time information and that education necessary to keeping qualifications met, et cetera, et cetera. It's a slippery slope. And if we don't understand that piece, we can't give you the tools necessary to make it as simple as that can be, as possible. Okay, this one is a good one. It's one of my favorite ones. Number 2, do remember that interest rates are fluid. What do I mean by that? It's a common mistake or misnomer, and no matter how much we try to articulate in writing, via the disclosures or initial emails, et cetera, when you guys come to us, and it's pretty common, everybody wants to know, hey, what's the rate? Okay, I'm not going to harp on why I don't think that should be the question, but if that is something that you're interested in and you get an initial quote, whether it be in an actual fee sheet or a loan estimate or just in an email, people will assume that just that delivery of information, that somehow an interest rate was locked. That is not the case. So you want to make sure that you're doing your part and your due diligence throughout the transaction. There's a couple other bullet points in here that I'm going to make that point again. But rates can change. And until you have been notified, hey, Jim, hey, Lisa, your rate is locked, it is not locked. You will get not only notification from your loan officer or dedicated loan specialist, you're going to get disclosures that very specifically specify your interest rate is locked at this interest rate for this long and whatever the costs associated with that. And rates change every day, you guys. They change sometimes multiple times in a day. So the second piece to this is that if you got a quote 30 days ago or 3 hours ago, and that's what your expectation is based off of, one, remember, it's not locked until we've said that it's locked. And two, you need to get some updated feedback. If it's been a week or whatever, you probably want to get back with me and or your dedicated loan specialist to say, hey, what are rates today? Have they changed from where I was last week or whatever it may have been? Chances are good that they have, even if only slightly. Maybe it's material, I don't know. But it can make a huge impact to what your expected ROI was going to be. So please continue to have that conversation and make sure that you've got real-time quotes on rates. The other piece of this real quickly, now that I'm talking about it, you know, it's not uncommon that an investor wants to do a comparison. And I think it's a good idea. I recommend looking at what is out there on the open market versus what maybe we're quoting. Perfectly fine. Like I said, even encourage our clients to do that. But very, very important that we're comparing apples to apples. So not only the day in which the rate was quoted. So if you're using a quote from a competitor that was given yesterday or a week ago or a month ago, and what we're giving today, that is not apples to apples, and it's not a fair comparison. The other thing too, as we're talking about this, not just about rates, the characteristics of the quote from, let's say, us or a competitor have to be identical. If the quote that you're getting from ABC mortgage company is for a 75% loan to value and ours is for an 80% loan to value, completely different things, and they are not valid comparisons. So in addition to rates being fluid, and you want to make sure that you're getting real-time updates, as that's important and necessary, that would be the other thing. If you're comparing, make sure that it's identical in terms of the transaction characteristics. So the credit score assumption, the loan to value, the loan size, the property type, all of that stuff has to be the same in order for it to be an appropriate comparison. Okay. Okay, I like this one a lot too. Do please respect your loan team's time. And what I mean by that, and I don't want it to be off-putting, because I know all of you respect our time and what it is that we do for our clients. But a lot of times there can be circumstances where there's a lot of people involved in a loan transaction. It's not just us or you, but it's us and you and an agent and a turnkey and an insurance agent and an escrow officer, right? There's a lot of different hands in this transaction. And very often we, as the lender, kind of are the ones not left holding the bag, but everybody is kind of, when there is leverage being used on a transaction, everybody's kind of looking at the lender for answers throughout the loan process. Perfectly fine. But keep in mind that there's lots going on in the background, and there's lots and lots of transactions that we're working on to get closed in the appropriate expeditious time frame that we have been designated to do so. So if we are getting emails and calls from you and the agent and the escrow company constantly, daily, even sometimes for updates, all that's going to do is slow us down, right? It's going to keep us from hitting the benchmarks and the turn times that are expected of us. So one of the things that I like to set an expectation on and recommend is, and it starts kind of grassroots organically. If we're telling you guys, hey, who do you want to be that point of contact that is going to get the update weekly, or as it is important to, or things change and important to update you on? Is it you, and then you're going to disperse the information to all the other third parties? Do we want it to be your agent or the seller's agent? There really should be one person on the outside of lending that is responsible to get those updates and then disperse it to the rest of the third parties. Because it does really become pretty cumbersome when we are having to stop and answer emails from 3 or 4 different people about the same transaction. It is not effective at all. And in fact, it can make for some cranky processors and underwriters in the big picture. So that was what I meant by please respect your loan team's time, and communication on who and when and how we want to disperse real-time updates would be useful. So having that conversation up front and setting those expectations. Number 4, be upfront about information that could affect your loan. So I want you guys to think of us as your attorney, right? Client attorney privilege. We need to know everything, absolutely everything that may be coming up, that may not be coming up. So because we understand how to navigate the battleship in a creek. Some of you have heard me use that silly term, but it creates a picture in your mind, right? If you think about a little teeny creek and then you think about a battleship and you have to navigate and turn that battleship around to go the other direction, that's how the loan process can be sometimes. And if there are things that might be pending in your world that you may not think are super relevant, if it comes up after the fact and we find out via the processes that we are obligated to, it could really create a lot of damage for you and us and all the other players in the transaction. So things like maybe you're changing jobs, right? And in your mind, you're making the same, maybe even a little bit more money than you were before. So why would it matter? It absolutely matters, because there's something called a verification of employment. And almost always there is a last minute VOE, verbal VOE that's done prior to closing the transaction. So if the processor calls up your HR department or your old employer that we had when you applied for the loan and says, just checking employment on Mrs. Smith, they say, oh, well, she doesn't work here anymore. That's an obvious problem, right? So that might not have been obvious to you when in the process of getting the loan closed. Very, very important to us. So things like that. What would be another good example of things that we've seen or that might come up? You transferred, let's say, the bank account that you used to show initially to get pre-qualified, that shows your down payment or your reserves or whatever, is in your B of A account. Okay, but let's say that you decided that you've got this other opportunity in the meantime. Maybe it was a new construction loan and you found there was another account that you could transfer 50,000 in and get some modest return in the meantime, right? Earn a little bit in the meantime. That is fantastic, but we were not made aware. So at closing, this is the account statement that we're using to show your source and season funds, but those monies moved. Now we have to stop what we're doing, maybe even redraw docs because we have to show the paper trail, et cetera, for the other account, right? We need to have all that information. So what might not be obvious to you is an important part of the loan process that you just need to be prepared for. So when you think about things like income or debts or assets or credit, right? Those kind of that trifecta, the three most heavily weighted criteria to qualify, even though there's lots of other things going on, those are the top three. If you think about it from those perspectives, income, liabilities, credit, and assets, anything that might be changing within the loan transaction from start to beginning or from beginning to end, let us know. Let us know what those might be, and then we can prepare appropriately so that there's no delays or any unnecessary brain damage.
Before we move on
Yes.
to the next one, Caeli, we do actually have a question from Martha here. Thank you, Martha, for your question. She asked, what is the preferred method of communication that will allow for quicker responses for all parties? Do we prefer phone calls? Do we prefer email communication? What's best for Ridge?
That is an excellent question, Martha. Thank you. And I think the answer is what's going to be, if you're going to be the person, I think it depends on the person that wants the information. It's really, so let's just say it's you getting the information. We want to know what your preference is, and we always try to ask that up front. So as the client, and that might be different for what title and escrow want. More often than not, most people want email. Okay, that's fine. But if you like text or if you like calling, right, you want that one-on-one, that's what we're going to try and do and how we're going to communicate with you. So be sure to mention that to your loan specialist. But I think the answer is going to depend on who is getting the information and how do they want that information delivered. So communication is always key, guys. Yeah, so if you like text or email, just let us know, or call. I like a phone call, and more times than not, I find that a quick phone call can save days. Constantly beating the drums with my team on that. If you've sent an email, and it doesn't matter to who, whether it was you or title or escrow or insurance or whoever it is, and you haven't gotten a call back in 24 hours, pick up the phone. I'll bet you that you'll have what you need within a few minutes of doing so. I'm a big fan of the phone. Okay, so do ask questions. Number 5. I'm on number 5, right? Yeah.
Yes.
Do ask questions. There is no dumb question, you guys. This is a new language, especially for newer investors, and not even just for newer investors, even for really seasoned investors, because things can change so rapidly in the loan side. It's always important to be informing yourself and educating yourself. So please don't feel hesitant or that you're bugging us. There's no dumb question. You need to be asking questions, always asking questions, and that's what we're here for, is to help guide and answer those questions for you. So please don't be afraid to ask questions. Okay, number 6. You guys know I love this one. This is one of my favorites, and I think it's probably up there, maybe in the top 3 of value adds that Ridge Lending provides for its clients. We want to see the draft version of your taxes before you file it, if qualifying in that calendar year is important to you. If it's not, then that's okay. Then we don't need to see the draft. But if qualifying that year is important to you, and if qualifying using full income and not some debt service coverage ratio product, which we have as well, then I want to see those draft tax returns. What am I going to do with that information? We want to have an advanced look at it so that one of a few things. One, we're going to see if there are any unintended omissions. And this happens all the time. So let's say that you give me your draft tax return and you've got 6 properties on there, and 2 of them don't have insurance listed as an expense, but you paid insurance on your rental property, right? So, and by draft tax returns, I'm focusing, sorry guys, I'm focusing on the Schedule E of the draft tax return. If you're self-employed, that would be important as well, even if you don't have rental properties, because self-employed is interpreted a little bit different than, say, a straight W-2. So that would also apply. But for this conversation, I'm kind of talking about that draft tax return when we're focused on the Schedule E, where the rental properties will live. Because while we all know that tax benefit, the deductions that we get to claim and then in turn pay less in taxes, are a huge part of real estate investing. It's, I think, obvious, maybe not. The more aggressive you are in those deductions, the more it can impact your qualifying over here in the debt to income ratio space. So we want that draft for a few reasons. Let me go back to my original thought. One, if there's any unintended omission. Insurance was the example I started to use. So you've got 6 properties and 2 of them, because I can look at those Schedule E's like nobody's business, right? I've been looking at these dang things for 20 plus years. So I can scan through there real quick and I see that there is a blank in the insurance column for 2 of the 6 properties. I'm going to write that down as one of my primary questions. Why was that not listed? Because I know you paid insurance. It's almost impossible to assume that you didn't pay insurance. And the omission of that, if it were filed before we got to see the draft, would ultimately hurt you. I'm going to explain why. It doesn't necessarily have to make sense. I think it's more of a visual thing. But the insurance and the interest and the taxes, some of those hard costs associated with your PITI, are add backs. And they're add backs into the total expenses because we're going to take it back out in the monthly PITI that we hit you for in the Schedule E calculation. Again, like I said, you don't have to remember that, and it probably didn't even make sense anyway, but that's okay. My point is getting a look at that draft in advance really gives us the opportunity to coach you, to give you the information that maybe wasn't intended. Oh, you missed this, or hey, you marked this as 12 months in service, right? So we're going to divide whatever income you claimed by 12 months, but maybe it was only in service for 2 months. And if there were $10,000 listed as income, and I divide that by 12 months because you listed as it was in service for 365 days, 10,000 divided by 12 is a much smaller number than if in reality it was in service for 2 months and it's a short-term rental or something, right? If I divide $10,000 by 2 months, I have $5,000 a month of income, right? So those are some of the things that we're going to be looking for on that draft tax return, and a lot more. Really, to get a handle on the need for draft tax return, we should be doing that one-on-one annually where we share screen just like this. We pull up the draft and I'll go through the return with you while you watch me take the information that we need from it, put it onto a pre-formulated worksheet, rental income worksheet, so you can see the pluses and minuses for yourself. I can't tell you how many times I have gotten a filed tax return that, had they known or been given just a little bit of pre-coaching or advice or feedback, it would have been the difference between qualifying and not qualifying. So it's a pretty big deal. Number 6, try to remember that one if you can, and it is applicable if you want to qualify that year and if you're trying to go for the golden ticket, the conventional loan, or some other kind of full income documentation loan. If you know you're going debt service ratio, and we've talked about it in the past, and there's just no question that's the route you're going, then I guess we don't need to see the draft. But I may caution you by saying, don't make that assumption. I wouldn't. I would want to see what the draft might allow us to do. You could be surprised because there's lots of add backs, depreciation, et cetera. Okay, I'll move on. Any questions you want me to stop for, Carly?
No questions yet, but please, everyone, utilize that chat.
Yeah.
Get in there, get your questions answered.
So number 7, do sign your disclosures right away whenever you get them, especially the initial disclosures. The initial disclosures, if they're held, or maybe you're just not aware of how the importance of them, it really stops the file from progressing through. For example, there's a disclosure within that package of initial loan disclosures that you're going to sign. It's called an intent to proceed. And without that being e-signed, we are not able to order an appraisal, for example. So very, very important that you move quickly on those disclosures that go out, because they are time sensitive. Some of them can expire and we have to redraw them. There could be several factors there. So when you get them, try to get to those right away. If you have any technical difficulties, let us know. It's usually an easy fix. It could be the browser that you're using. A lot of times Chrome is the best one, just FYI, when you're getting in there to sign your loan disclosures, whatever it may be. But yeah, that's a big one. Okay, number 8. Okay, so this was, I think it was Martha that asked that question earlier. So do save your dedicated loan specialist direct phone number. We'll call or text anytime. So if you guys save that to your phone, you've got instant access, quick fire stuff. Text, I find that text is a pretty easy way to communicate with most of our clients. I mean, how many of you leave anywhere without your phone? Leave the house, leave your car, leave work. I mean, how often are you walking around in the world without your phone, either in your hand, in your pocket, in your purse? Ever? And if you find yourself in a place where your phone is not with you, what happens? Panic sets in, right? So I know that everybody has their phone all the time, and it's an easy way. Yeah, me too, Michael. So text is a very common, easy way, convenient way for us to communicate. If it's good for you, stick us in your phone, and you can get us, well, not 24/7, but dang near close. Okay. Number 9, do alert us of large purchases or new debt so we can confirm DTI. So this is an obvious one to me, but it happens so often. I wanted to throw this on there. Maybe we're almost to the end of the closing. We're closing in 3 days time, right? Loan documents have been drawn. The appointment has been set. You're going to meet with the notary. Everything's ready to rock. But we're going to do our last minute. It's called a drive report. It's a national database that will allow us to see if there's been any inquiries for credit, meaning your credit was pulled for blah, blah, blah. If we see any of that, we're going to question it. And if it resulted in new debt, that in turn resulted in a new payment, what happens to a debt to income ratio if it's in your personal name? It's going to change, right? And even if it didn't, let's say that your car, and I feel like I covered this last week in a don't. So this is kind of a do and a don't all in one. I think last week it said, do not engage in any large purchases or new debt that will alter your debt to income ratio. So number 9, the flip to that is, do tell us, please, if that's going to happen. Let's say you're on a lease for your car. And it may not have occurred to you that you've got to turn it in and you're going to get a new lease. That's going to come up on our radar. So just, communication. Let us know if anything is pending or anything's happened or we think is going to happen. You're co-signing for one of your kids or a family member or friend or something. Anything like that will be important to give us a heads up on so that we can prepare for it and make sure that you aren't left at the signing table with a, oops, we can't fund now because DTI doesn't support debt and income. Okay.
And we do have one question
Cool.
coming, Caeli, from Joseph Burnett. Thanks, Joseph. He says, speaking of DSCR, is there prepayment penalty and how much would that be?
Oh, good one, Joseph. Yes, on almost all non-QM commercial and debt service coverage ratio loans, you should expect a prepayment penalty. Now, before I give you the actual formula, let me just preface by saying you'd have the option to buy out the prepay. It's going to be extremely expensive. Okay, so just be prepared for that. I can't give you an example. I'd need to have a scenario. Maybe we could do it together. Maybe we'll do that in one of our next live events. But you can expect a prepayment penalty. Very traditionally, a 3-year prepay on a more institutional loan. If this was a commercial loan, and remember, commercial can be used for residential properties. Okay. And just real quickly, subset, when we talk about commercial, there's going to be kind of 2 buckets. There's recourse and non-recourse. Recourse means you've got skin in the game because you signed a personal guarantee, and non-recourse means that you have no skin in the game, you signed no personal guarantee. Prepayment penalties between those two get harsher as you've got less skin in the game. Okay, and I'll cover prepayment penalties kind of approximately on commercial next. Let me talk about just a traditional, 30-year fixed debt service coverage ratio, more institutional, not commercial. 3-year prepay is pretty standard. You can have 1, 2, 3, 4, or 5. The longer the prepayment penalty, the better your rate is going to be. Okay, because that's going to obligate you a little bit more to keep that loan, and the investor is going to get more interest, right? So longer prepay, the better, because they think that you're going to keep that loan longer. They're going to get more interest. And if you decide to sell, they're still going to get at least a portion of whatever that interest would have been had you not refinanced or sold the property. The prepay is very typically, and if you guys have pen and paper, this may be useful to write down, very typically, like I said, 3 years. And how we're going to calculate that is we are going to take 80%, and it's not always, this is not 100% always the way the prepay is going to be structured, but I'd say 95% of the time, this is how you can expect on a 30-year fixed individual residential loan. 80% of the outstanding principal balance times 6 months of interest. So let me give you guys a scenario. Let's say, just for easy math, we're going to say the outstanding balance is 100 grand. Okay. So 80% of 100, we have $80,000. And let's say your interest rate was 6%. So $80,000 times 6% is 4,800. Divided by 2 is going to give you the 6 months of interest, because right now that's the full 12 months. So 4,800 divided by 2 would be $2,400 would be the penalty to get out of that loan. So whether you sell the property or you're refinancing the property, that would be the prepayment penalty. This is a unique question. I'm glad it was asked, Joseph, because let's talk this through for a minute. For those of you, we all probably agree that rates are going to come back down, right? How many times have you guys heard me say, when rates go up, do they stay up? No. When they go up, they come down. When they go down, do they stay down? No, they go up. So they're fluid, they're ever changing, they're gonna move. So we've been in a high rate environment for a while. And I think that everybody is predicting that they're gonna come back down. I have been saying since last year, I think fall of this year is when we'll start to see a little bit of a reprieve. I gave myself a buffer and said fall, maybe end of year, maybe first of 2024. So I'm going to be in that window somewhere. But my point is that if you got into, or you're going to be in one of those non-QM loans, whether it's commercial or just the 30-year fixed individual loan, and there was a prepayment penalty attached to it, and rates come down, they don't go down as fast as they go up. It's going to take longer for them to really come back down. But you can do the math pretty easily that says, okay, this is a long-term buy and hold for me. I'm going to have this property for at least another 5 years. Okay. I got and locked a rate of 8. Interest rates are right now at 5. So what you want to do with that information is, first of all, you want to figure out what the payment difference would be between your current 8 and a refinance at 5. Closing costs associated at that 5, but if you have equity, it's not going to be realized. It'll be just part of the transaction. You're not having to come from pocket. And then there could be some deductions that you can write off there as well, right? The points are tax deductible for an investment property, but you're figuring out the payment difference between those two, whatever it is. Let's just say it's $500 a month. I'm just throwing a number out there. Take that, figure out what your prepayment penalty would be. 80%, it's in your loan document. So make sure that that's the formula. It's not always the formula. A lot of times it's the formula. Figure out what your prepayment penalty is. And if it's $3,000, 500 savings, $3,000. What's the break even? 6 months, right? So in 6 months' time, that savings will have paid for that prepayment penalty. So how many people would say that it's a good idea that that scenario that I just gave you, how many people would pay the prepayment penalty, go ahead to get that savings? If you're not raising your hand, you need to rethink your math, because that makes sense. So how often am I beating the drums about doing the math? Do the math. So the prepayment penalty, that's the general formula. A lot of times, if you got a loan in the last 12, 18 months and it had a prepayment penalty on it, you may be refinancing in the next 12 or 18 months, and it might make sense, or it might not. Maybe you're going to have to wait until the prepayment penalty goes away. We won't know until we do the math. So that is on a residential type product. Let's move to the commercial. Commercial loans come with pretty harsh prepayment penalties. They don't mess around on those commercial loans, and it's usually one of two things. What time do we have? We're over. Okay, well, I'm still talking. If you guys are still here listening, I'm going to keep talking. Pretty harsh on a commercial loan prepayment penalties. It's called mortgage maintenance or a waterfall. A lot of times a commercial loan is going to have a balloon feature. It's going to be an ARM. Okay, let's just take the balloon feature as the term of the loan, and let's say it's a 10-year balloon. That means that at the end of 10 years, whatever the balance is due. You're stroking a check, or you are forced to refinance that mortgage. Different than an ARM where the rate can just adjust, right? But in my example, it's going to be a balloon. It's a 10-year balloon. And the prepayment penalty, you're going to choose up front between mortgage maintenance or the waterfall. A waterfall is going to give, well, let me start with the mortgage maintenance. Mortgage maintenance is harsher, and it's going to give you a better rate. Okay. The waterfall is not as harsh, not as good a rate. So mortgage maintenance is they're going to calculate, let's say you've got a 10-year balloon and you need to get out of this loan in year 3 or 4 or 5 or whatever it is. They're going to take the calculation of the balance and and the interest rate that you locked in, and they're going to calculate all the way through from the time that you're trying to pay off to that 10-year balloon anniversary date, how much interest they'd be losing, and that's what you're going to pay to get out of that loan. It's going to be a lot, okay? Commercial doesn't mess around. They want their money. They're going to get their money one way or another. The second one would be the waterfall, not as harsh, but still it's tougher than on the residential side. Waterfall is going to be, let's keep using my 10-year balloon example. So in year one, you're going to be paying, it's a 10.987654.321. Okay, let's just say that that's what it is. So in the first year of the 10-year balloon, you're going to be paying 10% on the outstanding principal balance to get out of that loan. In year two, it's 9%. In year three, it's 8.7654.321, right? It's a waterfall. So that's the prepayment penalty. That was probably TMI. You were just asking, I think, Joseph, for something a little bit more abbreviated, but there you have it. Enjoy. Are we on number 10? Any questions, Carly? Should I pause?
We are on number 10. No, you are good to go.
Okay. So number 10, do make sure you have enough liquid funds for the transaction and closing costs. Obviously, this is going to be important. I think I touched on this earlier, if you gave us a bank statement that showed your cash to close and your reserves, et cetera, and then we go to close and the funds are coming from another account, that's not okay. We're going to have to source and season those, et cetera. So I think this might be a better way to just say, try not to move a lot of money around throughout the transaction, at least within the accounts that you've supplied us to say, this is where my reserves and cash to close are coming from, and just keep it simple. If you have to, you have to, it's fine. Just be prepared that we're going to come back to you and say, I need a paper trail. Where did this money go? Where did this money come from, et cetera? And just make sure you know what the number is. Now, we're never going to be able to tell you what your exact cash to close is on the front end. That doesn't happen until almost the very end. We try to inflate the number a little bit to give us that cushion, right? You're 20 or 25% down. We come up with a very conservative on the closing cost side. So, right, we'll get you kind of a number. Just make sure you have that money. And then you've got your reserve requirement. Those don't have to be in a liquid form. Oftentimes, the reserve requirement for our investors is going to come from one of your retirement accounts, 401k, full life insurance policy, self-directed IRA, et cetera. That's where you're going to get those, and you've already given us the assets applicable to satisfy that, assuming that the terms of withdrawal say that it's applicable to use for reserves. That's another conversation. Okay, there's that. Any comments, questions, guys, about any of this stuff? Nothing, Carly?
Nothing rolling in yet, but please
Okay.
hop in there if you have a question about any of these top 10 or anything Caeli mentioned today.
I will say I've got it was Eustace. I think I saw him ping in, so I think he's here with us. I will say,
yes.
Is he here with us?
He had a question, but and then it popped out. I think he may have gotten rid of it, Eustace, but if that is something you want to ask. Oh, and we do have one here, a couple more actually that came in. So
okay. All right, just real quick, before you read those, Carly, for you, Eustace, he had a great suggestion. He wanted to know more about self-directed IRA for investing, and I am working diligently to get an expert on as kind of a guest speaker. I've known her for many, many years, and that is her wheelhouse. So I am working on it for you. As soon as I have that confirmed, I'll let you guys know. We'll announce it for you. Okay, I'm ready for questions, Carly.
Perfect. So Donnie's Webb, we have one here from her. She said, are there points with your QM DSCR loans?
Thank you, Denise, for the question. Yes, I think you guys right now, especially, there's not going to be an investment product, probably not even a primary residence product out there where you're not paying points. There's something called premium pricing, where under normal circumstances, you might be able to choose paying points or not paying points. And if you don't pay points, what happens to your rate, right? You have the option to pay a higher rate and no points. And sometimes that makes sense, depending on how long you plan on keeping the property, right? If you're only going to have the property for 6 months or 12 months or 2 years or whatever, a small-ish window of time that you're going to own that property, more often than not, it doesn't make sense to pay those points. It makes sense to take a higher interest rate. That's probably more to your advantage, assuming that you're factoring in the tax benefit of that. A lot of times people don't do that. And let's not forget, the higher the interest, the more interest claimed that you can have on the Schedule E, et cetera. But my point is that premium pricing right now where you can choose or elect to take a higher interest rate and not pay any points is not relevant on secondary markets. And the reason for that is secondary market knows that you're going to be paying these loans off almost certainly in the next 12 to 18 months. Because as we just talked about, rates are high right now, right? We expect that they're going to be coming down. So everything that was locked and closed and funded over the last 18 months are at those higher rates. So everybody's going to be looking to get those into lower interest rates. And the servicing rights take a period of time to recapture a premium that they paid. So maybe we should add that to a topic because it's a little bit convoluted. The point is that you shouldn't expect to have any products out there where you're paying 0 points. There's always going to be points associated. Our compensation, as most of you know, we charge 2% origination on all non-owner occupied transactions. So hopefully that answers your question, Denise. Let me know if you have anything more specific. Shoot me an email. Whatever's good. What do we got next, Carly?
All right, JC, she actually has got a few questions for us. So I'll just start with the first one here. She asks, how do you juggle getting a new credit card to improve your credit profile versus active property investing, the timing issues between the two?
Okay, so your credit score is maybe just kind of stalled and you're hoping to build credit and increase the score, right? JC, is that the question? Probably. I would say that ideally, this is ideal, if you're going to be building that, and this is for scoring, okay? The first thing I would tell you is that there's other mechanics that you can go into. What is it called? I think it's Experian. One of them has this thing where you can add like your bank account to it that shows all of your on-time utility payments, like your electric bill, your gas, your cell phone, where it can pull that data from your account and show that you've got those on-time payments if you don't have real depth of credit yet, that can really boost a score. So that might be something to check into. Otherwise, a credit card, I would say 12 months, maybe 6 months in advance. If it's for credit stuff, I would want to have a one-on-one conversation with you to really understand where you're at now, so I can give you more tailored feedback. But 6 to 12 months, probably, if you're going to open up a new credit card to see any real impact or benefit to the score, keeping that utilization, if you can, to 30% or less. That's ideal. That's optimal. So utilization, $10,000 limit, 3,000 or less in the balance section is going to be ideal. 50% less is still very good. If you have utilization at over 50% of a credit card, it's really going to start jacking your score. It's going to really reduce your credit score. So there you have it. JC, email me and we can talk more specifically about your circumstances. And I think I can be more valuable for you there.
All righty. And then the next question from her is, can you please talk about shopping for a mortgage?
As it relates to credit score, I think you mean in inquiries. If I had to guess, that's what I'm going to interpret from your question, JC. So I think what you're saying is that I want to shop for a mortgage. I want to see what options I have, what rates that this lender has versus this lender terms, et cetera, which I encourage. As that relates to your credit score, there is a lot of bad information out there that says if every time you have your credit pulled, that it's going to drop your score 50 points, 10 points, 20 points, whatever it may be. I've heard everything in between. That isn't the way credit scoring works. Inquiries, as it impacts a score, is really more about an individual going out there and having their credit pulled for a variety of different reasons. So let's say that you went out and bought a new car, and then you went and bought a new flat screen TV, and you opened up a department store card. All of these different inquiries are going to be from wildly different perspectives. The algorithms within the Equifax and the TransUnion and the Experian, the zeros and the ones, they're seeing that individual is about to potentially become overextended. And that's when lots and lots of inquiries can really damage a credit score. If you're shopping for the purpose exclusively of mortgage-related finance, you have a certain window of time that you're allowed to have your credit pulled as many times as necessary for your consumer checking without it adversely affecting the score. And even if there's some issues with the inquiries, because maybe you had some other inquiries for things that you had to do before, in addition to mortgage that's coming up, you can always elect to do a soft pull. We can do a soft credit pull, which will not impact the credit score. And we can always start there when we're doing the vials of blood and DNA samples thing on the front end.
All right, perfect. And then the next one here we have, do assets make any difference to rate and qualification?
Yeah, sure. Not to rate, sorry. Assets have no bearing on the interest rate whatsoever, unless you were doing an asset depletion product, which means, let's say you have $500,000 in a self-directed IRA, we can take a monthly amount of that and utilize it for income. But that's a whole nother thing. I won't get into that. But I think as it applies to your question, no, assets are not going to have any impact on the interest rate itself in general terms. On qualification, yeah, of course, you're going to have to supply enough assets sourced and seasoned. And I can define that on another call, guys, what sourced and seasoned means in order to your down payment, whatever that may be, and or the reserve requirement. So assets will be required for qualification, yes.
All righty. And then we have one more here. Let's see. Iffy, I'm so sorry if I'm pronouncing your name incorrectly. He wants to know about the impact of changing jobs on qualifications. And it sounds like you have a specific scenario that you want to ask Ms. Ridge about. So we're going to go ahead and unmute if that's all right to answer your question. Let's see here. Let's go for it. All righty.
Oh, okay. Thank you so much. Can you hear me?
Yes, we can.
Hi, we can hear you. Carly, you can
Okay,
get rid of the share screen.
Oh, yes, of course. Thank you.
Hi, Ify.
Hi. So my question is this, just want to understand the impact of changing jobs. And I just want to specifically talk about my own scenario and see how that can actually affect qualification. So I started working for a company in 2019, and then I stayed there till 2022. And I moved to another company in 2022, but in 2023, I went back to the former company. So in that dynamics, it shows, of course, I changed jobs, right? But how can that affect me qualifying for a mortgage loan if I want to apply as, let's say, now?
Just that by itself shouldn't have any real negative impact. Question for you. Is it the same line of work? So the first and then the switch, and then obviously back to the first is the same line of work. Was the one in between basically the same thing that you're doing now?
Yes, it's the same.
Then zero impact whatsoever. Any job change, guys, as long as it's the same line of work that you were in prior, is not going to have any, that activity by itself will not have any negative impact whatsoever. Now, the rate of pay in which you had before versus what you're having now, if it's less, for example, or let's say that you have a great opportunity where the base is less, but you've got this upside of bonus or commission in this new job, same line of work. But if you've never received bonus or commission prior, I can't give you any of that income until you've had a 24-month history of it. So let me just say that again. In your case, Ify, there's no impact. You are good to go as long as the income and the debt to income ratio calculation is still where it needs to be. So the changing of jobs, no problem whatsoever. What could be an issue for somebody is if they were changing jobs, again, same line of work, all of that's relative, fine. But if you had $70,000 as a base pay prior, you took a new job, same line of work, making 50 base, but you're going to be getting another 40,000 a year of commissions or bonus or whatever it is. That's great for you, but for underwriting purposes, that extra bonus or commission on our end, because it's brand new to you, you never received it before, you will not be able to use that as income for 2 years. We have to have 2 years of that type of income before we're able to average it out and give it to you for qualifying purposes. That might be okay, because maybe your debt to income ratio on the 50,000 base is more than enough to satisfy a 50% DTI or less. So the math is always important, and make sure that you guys are doing it. Hope I answered your question, sir. Okay, we are so over time. This was great. You guys, thank you for the questions. This is what I kind of hope for when we get together, and I hope that it's beneficial to you. Keep coming back. I don't know what we're talking about next week. I think Carl, no. Next week is 4th of July. Happy Independence Day, everybody. So will you do another, maybe just do a quick poll. If anybody has any content that you want me to talk on, I can pre-record something, 5 minutes, anything, it doesn't matter. And I'll throw it out on the community so that if you guys are just sitting around doing nothing on the 4th, yeah, right. Or that week or whatever, we'll have something for you. And then we will post or blast something between now and next week that lets you know what we're going to have topic wise on the, what is it, Carly, the 11th?
It's the 11th. Yes.
11th.
Yes.
Okay. We'll keep you guys posted. Thank you for being here and sharing your afternoon with me. Appreciate you guys so much. We're on standby. ridgelendinggroup.com, info@ridgelendinggroup.com, 855-74-RIDGE is a way to contact us via phone. You know how to get us. Peace, my people. See you guys.